I want to welcome everyone today. Next slide, please. So this webinar is being sponsored by California Lutheran University's financial planning program. And the financial planning program at Cal Lutheran provides two flexible degree programs, the MBA and the MS. And the curriculum is designed to prepare people for the CFP examination and get your degree. Or, you know, there's other people that come into the program that already have that designation, and we have courses designed special for them that are more advanced and interdisciplinary. So just wanted to let everybody know about this program and that we're sponsoring it today. Next slide, please. I'm going to turn it over to Terry, if you're ready. And Terry's going to introduce our speaker today, Igor Zey. Terry?
Okay, thank you, Cindy. Everybody can hear me well? Everybody can hear me wonderfully? Okay, wonderful. Great, thank you so much for being here today. Igor Zey has been a frequent speaker on the subjects of financial, charitable, and estate tax planning in the context of marital dissolutions, employee stock option plans, executive compensation, disability and life insurance planning, and asset protection planning to various professionals, groups of attorneys, doctors, CPAs, and insurance producers. And so many of his courses have been approved for continuing education credits. And he is currently a PhD candidate in financial and retirement planning and received his Master's of Financial Services from the American College of Financial Services. And as if being a wealth of knowledge wasn't enough, near and dear to my heart, he is very much interested in Krav Maga and kickboxing. So I love all of this stuff. So hopefully we can learn something wonderful today. Thank you so much, Igor, for being here.
Oh, thank you, Terry. I would much prefer the chess part of my hobby, but that's fine.
No.
Good morning. Well, thank you for inviting me to share some of my thoughts on after 37 years of being in the financial and insurance business, the issue of commissions and various other forms of compensation in the context of ethics has come up on numerous occasions. In fact, actually, it comes up daily. And so I have a few thoughts to share, and thank you for listening. But in order to put that in the proper perspective, we need to create the theoretical framework behind the evolution of the client-advisor relationship. And so, you know, over the past several decades, the field of financial become more than their even counseling. So the theoretical framework behind that is in my opinion, is the agency theory. The agency theory guides the relationships where one principal is ordering work and another is the agent who is performing the work. In a pure laissez-faire context, the agency theory is a contract between two consenting adults, hopefully, or two consenting parties exchanging and trading their respective goods and services, while at the same time reconciling various dichotomous problems of various conflicts of interest. Well, that's in theory. In practice, in a more complex world, the picture is by far more complicated with various rules and regulations, taxes, fees, special privileges, and individual biases and heuristics and various what we would call for now human proclivities. So in short, the government is also very much involved in regulating the agency theory contract between the agent and the principal. So as such, the agent, the advisor, or the insurance agent brings into the relationship her advice, products, and services. The principal, the consumer, brings the payment of the advice. And so there are three general methods by which the advisors get remunerated or get paid. Fees, commissions, and fees on assets, or asset fees, or AUM, assets under management fees. So again, fees, commissions, and AUMs. Or sometimes it's a combination of all three, depending on what is brought to the table. So philosophically speaking, in contravention to Immanuel Kant, deontic approach of prescriptive ethics, if you will, advisors, in my opinion, do not owe a duty to their clients unless they get paid, right? So, nor is their relationship should be based on the utilitarian principle of most utility. The agency theory on the remuneration is an ethical contract based on the enlightened self-interest of the parties. It has been demonstrated numerous times in the past that the government's involvement in disintermediation has produced, at best, dubious results. Well, let's say the Affordable Care Act is one of the examples, and I don't want to get any more controversial, but specifically the most recent attempt by Department of Labor fiduciary rule would most likely create serious problems for many low assets investors and would leave them without advice simply because they wouldn't be able to afford fee-only advice. So the agency cost, and that's the under the agency theory, that's the name for the remuneration, is merit-based. Commissions are paid on products sold. Fees are paid on the advice associated with properly coordinating income tools and various endogenous and exogenous risks with individuals, investors' goals, objective needs, and both objective and subjective desires. So under the agency theory, compensation of the advisor is a function of how well she served the client. The better the job done, the higher is the agency cost. Now, all that is theory. So in practice, it's a function of what products and services the advisor brings to the table. So that's the framework. And let's see, where is my slides? So is the commissions good or bad? Well, let's just discuss that in the context of agency theory as a framework for shaping compensation structure that is most ethically fits under, I would say, the Aristotelian agent-based system of ethics. An advisor-client relationships is neither deontologically dogmatic nor utilitarian relativistic. And so let's move to were the three primary models by which the investors pay for professional advice. Again, commissions, asset fees, and flat hourly fees. So the debate over which is best, in my opinion, is fundamentally flawed. Since first, all three models contain incentives that can lead to conflicts of interest. Each one of the three models represents the optimal choice for certain investor circumstances. The recent trend, probably the last 20 years, has been the trend has been away from commissions and in favor of fee-only planning, and it may not represent the best model for the profession. Alternatively, it can be argued that the ideal compensation platform should incorporate essentially all three models. So in the, you know, it's utopian to assume that that we can find a truly fair and objective compensation platform that fits everybody. And here's why. because we have what's called informational asymmetry. And this is not only about the disclosure of our compensation to our clients. That is fairly easy. But it is the disclosure in and of itself, and many studies have shown that is fairly low-yielding informational issue. It's one thing is to disclose, and another thing is for your client to understand it completely. And so, for instance, just as a quick side note, we killed an enormous amount of trees printing prospectuses. I don't know anybody who has ever read one. I don't know many professionals that have read those prospectuses, although that's what's required. So we have to take into consideration the various behavioral, cognitive, and psychological heuristics and biases of consumers, and how they are adjusted. And so what the compensation is. So let's talk about really quick, I'm running out of time. So the commissions in themselves are neither bad or good. They're just that. So what do we do? So where do we go? Is it right or wrong? I posit that it is neither. Okay, it's just that. So in fact, I think that some advisors have adopted that almost religious fervor, moralistic position in advocating the exclusive use of a fee-based model, and they've been so local that there has been very little formal discussion of limitations associated with either one of these methods. So, so on the no, well, let's see. The somewhat in a simple way on the commission, no single compensation model assures investors that the advice they will receive is entirely unbiased and objective. All three models have limitations. The financial planning community should think carefully about promoting fee-only planning as a best practice model for the profession. Each model also may be an optimal choice for certain set of investor circumstances and for certain set of products and services that are provided. So just to give you an example, I would like to actually, in the interest of time, just bring a real quick comparison. A financial planner, and I mentioned that in the very beginning, we have a very complex world today. And if we look at it from the standpoint of what we bring to the table, as financial planners, we bring the design, the process, we combine the income tools with balanced goals and risks. And how do we do that? First, we assist our clients in providing goals. We assist our clients in ascertaining risks. And then, as we put together a cogent, hopefully, financial plan, we come up with various income tools. Because I always want I always use that as a comparison. You know, it's like being an architect and being a general contractor. Building blueprints is not enough. It's a blueprint. A financial plan without implementation is a Gideon Bible in a Las Vegas hotel room. It's useless. Now, somebody has to guide the client, and I can talk for hours about various paternalistic nudges that we have to employ in order to help our clients to achieve their financial goals. We have to help them with construction. And the construction of the plan brings us to income tools. So aside of if you go from right to left in the clockwise, other than Social Security and corporate pensions, everything else, starting from health insurance to long-term care insurance, to reverse mortgages, to life insurance, to equity, to variable annuities, deferred income annuities, and everything else from there on, they pay fees. And they pay what kind of fees? Well, most of them are commission-based. Some of them are fee-based. Now, AUM. assets under management. What we charge our clients for is the advice. We charge an hourly fee or flat fee for helping the client to ascertain their goals and risks. And on the implementation part, if we sell the product, then we should be getting paid in the commission. That's how I look at this, and this is where I should open things up for questions.
So does anybody have any questions for Igor?
You know, I didn't necessarily have a question, but I really started thinking about the CFP marks and how committed the board is to ensuring that, you know, planners are seen as planners and maintaining a fiduciary standard, and the idea of, you know, the ability to use the term fee only and how that is supposed to bring about, at least we hope, a certain sort of comfort that we're on the same side as the client. And so do you, Igor, see any potential conflict in this or resistance to the idea that, you know, fees only is quote unquote just as good as commissions or a combination, and that we shouldn't be trying to create a delineation?
Well, that's a great question, actually. It has to do with the whole, as I call, moral schizophrenia, or in a lighter way of explaining that, it would be just a false dichotomy. Again, it's in the what context are we getting paid? Are we getting paid as architects, or are we getting paid as general contractors? If I build a portfolio for my clients, and I should be able to have access to all kinds of products and services. If we're talking about fee only, one of the biggest problems with fee only financial planners is they shy away from anything that may be that generate commissions and may be extremely important in the overall plan, financial plan for the client, be that long-term care or disability insurance or life insurance or various income annuities. So also, because fee only is not specifically tied to performance, there is such thing called shirking in the fee only community. Basically, putting the client into something into some type of investments where the performance cannot be easily ascertained, be that some hedge funds or real estate. So the concept, again, it's not fee against commissions. It's what do we do in any particular part of the financial planning process. If I am planning for the client and I'm telling the client what to do, what not to do, and it's counseling and it's in fact hand-holding, and I'm working with the client's psychological incongruencies or either a lot of risk aversion or too much risk-taking or whatever, and the client follows my advice and we put together a plan, that is a fee for service because there is no product involved, and that's an hourly fee, akin to a CPA, akin to an attorney providing legal advice or accounting advice, respectively. Now, if I move on to implement the products and I said, oh, by the way, here is part of, as we implement the plan, these are the recommendations. You can go to somebody else to implement that, but then I lose control over the process because I don't know how somebody else is going to implement my plan, because the plan, again, is only as good as it is implemented. So then I get commissions. With the full disclosure, with the full understanding, I think there is no conflict. So I don't know if that's a good answer. I mean, maybe a little bit too winded.
I have a question.
Yes.
This is Jack Cutler.
Yes. Good morning, Jack.
it seems that, and you said this earlier, there's no absolute right or wrong. And given that you guys see so many different types of situations, it seems that I would assume that most people have different types of fee structures according to what the client needs. So two extremes would be a 25-year-old asking basically for someone to administratively do the work to get a small term insurance versus the extreme that you were describing a few minutes ago. Those fee structures, I would think, would be very, very different because of the services provided. So my question is, do most people have different fee structures according to what their situation is? And if so, are those adequately and clearly disclosed to the client so they understand what they're getting, what they're paying for?
Well, there are different disclosure requirements. If it's regulated by the 1934 Act, then it's just that covers the commission disclosures. 1940 Act requires a significantly higher fiduciary level duty disclosure with respect to fees. Now, that's the answer to that is only, again, by using your example. If we're taking a 25-year-old who needs a basic term insurance and the disability insurance, or set up a Roth IRA or IRA, it's very little planning advice that goes into that. And in order for a professional to be involved with that level client, that the professional needs to be properly compensated. And the commission is probably the most appropriate compensation form or structure. Or if you get into a more complex situations where the client can afford fee-based planning, then I would imagine the combination of both would be appropriate. Just as a side note, the most expensive compensation structure is fee-based.
Okay.
Wow, I would not have guessed. Well, I don't know if I would have guessed that it was fee. Is it by a large margin? Do you by any chance know, or?
Well, I mean, we can look it up. Actually, there were multiple studies in advance done when the DOL fiduciary rule was almost implemented, that it would literally cut out 30% of the bottom market from professional advice. They wouldn't be able to afford the fee-based structure. So, I mean, expensive is relative, right? I mean, you can get from point A to point B either on a bicycle or on a BMW. So it's just a question of how fast and how efficiently do you get there.
Mm-hmm, mm-hmm.
So the more complex and the larger the estate, the closer it gets to be shifting from commission and AUM based to financial planning, to fee only, or a combination. Again, I am a big proponent of looking at things objectively. If I'm doing an architectural component of the financial plan, then it should be fee based, whether flat or hourly. If I implement the products, I should be compensated on either commissions or AUM. And I don't think there is a conflict. Double dipping would be is when you don't disclose, or when you're or were you doing the opposite, which is practically an immoral thing to do. In other words, you sell the product and then you call it a financial plan. That's not financial.
Right. You know, I also found interesting, you know, I like the comparison, the difference between someone drawing up plans versus being an architect. And I combining that with this idea of, or the comparison of disclosing information versus how much understanding a client actually has. And I wonder if in order to create a sort of an overall acceptance of any sort of way that we are compensated, right? If there's just really going to have to be more emphasis placed upon educating the clients to make them understand that you're actually getting an architect. You're not coming in here or my business model is not, okay, I'm just going to sell you something and move on, because that's what your understanding has been. And then I start to wonder, well, how much is too much?
Well,
I guess it just depends on each client. So.
Well, that's an interesting thing. There are multiple studies that have actually shown that the efficacy of consumer education is very, very small. It almost doesn't make a difference.
Yeah.
Educating the client in the financial planning field is rearranging the lounge chairs on the top deck of the Titanic for the most part. And it's unfortunate that we spend hundreds of millions, billions of dollars in educating the general population, where we should take a fraction of that and build more financial planning programs like CLU does with an MBA and the CFP track that actually educates and weeds out the bad weeds of those that enter into a financial planning field. I think that would make a much bigger and a much more positive difference in the lives of our clients. That's a
good point.
Maybe,
yeah.
It's maybe a little bit too passionate, but I don't know how to do things differently.
Okay.
It's been my experience. I have actually accumulated quite a few studies that was part of the PhD program that actually show that educating consumers makes very little difference. And it's also my personal experiences. All right, we have a fairly educated, college-educated person that going through a divorce receives $1.5 million in a settlement, and within 2 years blows it on Indian casinos. All right, there you go.
Yeah.
So, I mean, college education makes no difference in this case. I'm sure she knows how to balance a checkbook.
Mm-hmm. Well, it's fascinating because I don't know if anybody saw it, but I believe it was the January Journal of Financial Planning, there was the article, and I can't remember her name, but she sort of each year goes through all of the stats for the previous year, and it was quite interesting to find out the number of people who think they know a lot about different areas of financial planning from a consumer point of view, and they think they know more than they actually do. So there's sort of this sort of false confidence.
That's a classic framing effect. That's Tversky and Kahneman actually wrote that and extensively on that.
Mm-hmm, mm-hmm.
Well, people think they know. It especially applies to doctors. That's a halo effect. If you're looking at this, that's the one on the right. That's a doctor.
Oh, okay.
They think they know. It's called a halo effect. It's just because you are very educated and very knowledgeable and a high level professional in one particular area of life, you begin to think that you can do the same thing everywhere else. I mean, we live in a highly segregated, vertically integrated society. If we don't delegate, just like the expression, an attorney who represents himself in court has a fool for a client, it pretty much applies across the board to everybody. Not having a professional financial planning advice, and not only having that, but follow it. Not necessarily blindly, but at least have a relationship that allows them to avail themselves to the expertise and the integrity of their financial planner. I think that's critical. And of course, it goes both ways because,
Mm-hmm, mm-hmm. Well, and then that particular study also noted that that there were certain segments of the population, for instance, women who actually didn't give themselves enough credit for what they did know, right? So you have overconfidence, and then you have, in some instances, individuals who should be a little more confident in what they know. They don't know everything, but they know more than they think they do. So at any rate, I found that quite interesting. Any thoughts on what direction you think this is going to go after doing your studies? In terms of commissions, fees, what do you think moving forward?
Well, I think the CFP Code of Ethics kind of is in dire need of being upgraded. But it is fairly deontic and prescriptive, and it's basically kind of in a way, a little truncated and a butchered 10 Commandments, where it should be a little bit more dynamic and more agent-based rather than action-based, philosophically speaking. So there's a little lacking of Aristotelian thought and a virtue in a CFP Code of Ethics. One of the best examples of that would be that we should sacrifice our well-being for the benefit of our client. And I think that's just the wrong dichotomy. On the face of it, it looks good and sounds right, especially in the Judeo-Christian concept of morality, right? But in reality, it deprives somebody of something, all right? And in other words, why would I be in this business if I don't get properly paid? So even though in any particular discrete situation, yes, I would obviously put the interest of my clients above my proclivities, not my personal needs and wants, but my proclivities, for instance, okay, assuming that I'm rational. But in the larger scheme of things, if I will not work for free. So if we take it from sublime ridiculous, financial planners should not be working for free, just like doctors should not be working for free, just like attorneys should not be working for free. So the compensation model in and of itself should be rational with respect to what we bring to the table and what are, again, bringing back the agency theory and what our principal is willing to pay for it. So it's a contract. And how we get paid is really a function of what we bring to the table rather than whether one way of compensation is better than the other way of compensation.
Mm-hmm. Well, if there aren't any more questions, are there any more questions before we pass it over to Cindy so she can close this out? Thank you so much, Igor. That was great.
Thank you. Appreciate it.
Igor, I appreciate it too. This is Cindy, and it just, it puts a little bit different perspective on it for me. And so thank you for today. So with that, as I said earlier, the programs, these webinars are sponsored by California Lutheran University's Financial Planning Program. And if you're interested in the program, can you go to the next slide, please? Feel free to reach out to either myself or the director of the program, Dr. Chen, and we'd be glad to give you more information about the program and see if it would be a good fit for you. I want to remind everybody that next week's presentation is going to be on critical illness near retirement. And Kimberly Turner will be presenting. So watch for the registration email, and we'll look forward to having you come back.
I highly endorse that. Kimberly is from the same college that I am from.
Yeah, she is. She's working on that PhD. So, all right. Thanks, everybody.
Thank you, Cindy.